Hello, hello. Welcome to Ready Set Live for March 4th. How's everybody doing? Where's everybody coming in from? Let's hear it.
Hey guys, welcome aboard.
All right.
Let's see, we got the Lone Star State in the Heezy. We got Tacoma, Washington. We have Germany coming in today.
Very
Everybody
nice.
having fun in the markets lately? You guys enjoying the volatility? This is like once every 10-year volatility. This is incredible.
Wow. All right. Yeah. Awesome. Look at that.
Let's see, we got Suriname. All right. And we have LAX, Tampa, Florida, Lithuania, South Carolina. Hey, Chris. We got New York City, BC, Canada, Yakima, Washington, North Dakota, Indiana, only sober people on YouTube. Hello.
At least on Wednesdays.
Yeah, that is true. Yeah, you know, we actually did consider doing a beer crypto video series for a while there. But then I think we actually do have video evidence of us cracking a beer and talking about crypto.
Yeah, but people were giving us too much guff. We're like, oh, are you guys depressed? Are you guys okay? Yeah. Like, no, it's okay.
It was not only that, but it was also we were getting assaulted for the brand of beer that we were drinking.
Oh, yeah,
so
yeah.
It's like, so the religion it just never stops.
Oh, man.
Let's see, Columbia, Maine, Malibu, California. Mav, right up the road from you, man.
Yeah. All right.
Coming in from Norway. So what's up, guys? We got a couple of things for you guys to talk about. Mav, you got a little
return to form, back to the PowerPoint days. Yeah,
back to the PowerPoint days.
Won't be very long. Yeah, promise.
Oh, so are we going to have any? Let's see. The last time we got together, did we crash the market?
Oh yeah, wow.
Was that this week or was that 2 weeks ago?
I think that was 2 weeks ago. Yeah.
Yeah. All right, we won't do that today.
Not today. So no, we've had enough of that.
None of that today.
Oh my. Yeah. So yeah, let's talk about it. What's going on in the markets? What we got?
Oh, you want me to grab the steering wheel here and talk about markets?
Yeah, I think that'd be appropriate.
Okay. All right. So I'm going to do a little share screen here and jump over to this. Okay. So I'm assuming you guys can see what I'm looking at here. Let's go full screen on this, dude.
I screwed it up again.
Nope. Okay. So I'll hold on a second here.
Zoom does this to me every time. I swear yeah. All right. We'll just do that. I swear I change this every time, but it doesn't matter. All right. We're good.
Okay.
Yeah.
All right. So I'm assuming you guys can see this. This is the S&P 500. Now, the one thing I want to bring up to you guys, like, this is where we have to get outside of our own little bubble of crypto and talk about the larger markets, because until you understand what's happening with the larger markets, your asset will be a hostage to the larger forces going on. So look at this move that occurred last week. This was somewhere on the somewhere around $6 trillion. Would you guys realize that that is 25 times the drop that we had is 25 times bigger than the entire crypto market? So you have to keep things in perspective and understand what's going on first. So a lot of people are saying, all right, well, what's going to happen in the larger markets first? What's going to happen in the larger markets? And because of this drop that we had so many margin calls and redemptions out there in the larger market that crypto as a secondary asset, of course, is going to get affected. People are going to raise cash, and that affected the crypto market to some degree, but not really that badly. So I see three different ways that this is going to play out. And I don't know. So for anybody that is out there making predictions as far as what's going to happen, they don't know. You don't know. Nobody knows what's going to happen tomorrow. So get that straight. First of all, nobody knows the future. All you can do is prepare for whatever happens. So few people were expecting this move, but the market professionals were prepared for it in case that did happen. Okay, so three different ways that this is going to go. Obviously, up, down, or sideways. I think we have a very low probability that we're going to see a V bottom here. A V bottom is going to be one of these, just like snap the whip kind of move like this. And we had one of those back in 2014 with Ebola. So the Ebola virus gave us a 10% haircut in the market. And then we immediately rebounded from there as people realized, I think we made a little bit too much of the Ebola virus.
You haven't been able to get a haircut since.
Nah. And when I talk about I'm talking about the media. The media completely overblew the Ebola virus. There was that one person that got locked down and she made a big deal out of it. I don't know if you guys remember this. We're going back 5-6 years ago, but it was just a media circus about the Ebola and everybody was just frightened out of their gourd. Same thing is going on. Perhaps this one is a little bit, perhaps the COVID-19 is a bit more serious, but I think a lot of people, I'm sure Mav, you're going to bring up some statistics in your presentation, but so many more people have died of the flu than this thing so far. Anyway, so I'm not here to debate what's going to happen with COVID. I'm just looking at the larger markets right now. So one way is definitely for us to see a V bottom. I don't think that's going to happen. I really don't. I think what's likely to happen is that we shake and bake in this area as the market tries to find some sense of certainty. And there's not going to be any certainty in the short term. And I think the most likely outcome is that some other factor comes in, or all of a sudden it swells past the number that we thought. And I think we'll get a retest of the bottom. That to me is the likeliest scenario. I think the best outcome from this would be is that we shake and bake in this area, we drop down and form a scary higher low, and then we take off. So this would be not necessarily a retest of the bottom, just like enough to imply and get enough people to just puke out their positions and cause their short covering to the upside. So longer term, I think this is going to be okay. Now, I don't know if that's going to create a lower high or not, but I think we're going to carry this volatility for weeks and weeks and weeks. I don't think it's going to go away anytime soon. So one of the problems here is, now I know what you guys are thinking. I've heard you guys talk about this for years that, hey, crypto is the ultimate hedge to the equity markets and the sins that the equity markets have done with printing and going to negative interest rates and everything. I want to show you guys something to give you some historical perspective. Let's go look at gold. So everybody generally agrees that gold is a great hedge against inflation, against pretty much anything bad that's going on out there. Let's go out to a monthly chart for gold or the GLD. And what I want you to focus in on is this right in here. This was the time of the financial crisis back in 2008. This move here. What I want you guys to understand is that everything got sold. There was no safe harbor. everything got sold. And so that includes crypto if this is going to happen. So the initial move is going to be down. If we do crash from here in the larger markets, everything goes down first, and then those assets that are considered to be a safe harbor will eventually surface from those. So understand that. Don't expect Bitcoin to just take off right now until we do get some certainty in the markets, or we're finished going through the crash process, which is in this area. Okay. Something else going on, which is huge right now, is that we have a really bad looking yield curve. So this is what a normal yield curve looks like. And I don't know if you can see this, but this is a positive yield curve where the further out dates have higher rates. And that makes sense to everybody, right? But now we have actually the rates for the 2 and the 3 and the 4 and the 5-year notes are actually lower than they are today. And they're approaching 0%. And pretty soon we are going to have negative interest rates unless something changes in a hurry, which is part of certainty. So this is a huge impact on the market. Now you may be looking at that and saying, hey, well, crypto would be a great hedge against something like negative interest rates. That's true. However, keep in mind, we have to get through the crash phase first, and then we can play that hedge game. There's one more thing I want to show you guys. One of the problems that we had last week, and I don't want to get political here. This is nothing to do with politics. It's all due to market certainties. One of the uncertainties that came into Wall Street last week in the larger markets, and this is FTX, they actually have options here showing the probability of the US presidential election. And one of the problems that markets had last week was that Bernie all of a sudden started to rise. And Bernie, as you guys know, he's been advertised as anti-financial, anti-financial this and that, hates Wall Street and everything like that. If Bernie were to get in the White House, Wall Street and the general financial industry would be rocking and rolling for a number of years, right? It would take years before that would recover. And if the market even senses that that's going to be a possibility, it's going to be sell first and ask questions later, much like what we saw in 08. And so one of the reasons why we're seeing a somewhat stronger market today in the last couple of days has been the resurgence of Sleepy Joe. So Sleepy Joe's coming up, right now it's got a 33.8% chance of election, according to FTX, and these options in there. And of course, if you want to look at the Cheeto monster is still sitting at a 56.6% chance of election. So again, this is not to do with politics. This is not to do with my read on it. This is purely neutral, and this is an option exchange set for understanding where people are voting with right now in terms of buying and selling these binary options. So something that you can look at here and get a very unbiased view. If you're tired of going to, biased sources for news, just look at the markets. The markets will always tell you exactly what is priced into that. So I could go on, but I'll tell you what, guys, I'm going to throw it back to Mav and see what else is out there. And I'll certainly take your questions later on today in today's session.
Yeah, it's funny. We got a comment on the last stream where we talked a lot about the coronavirus last week for those who didn't tune in. And someone was saying, oh, you guys are pretending to be medical experts, trying to explain away coronavirus. And no, we're not up here to pretend to be, political strategists or medical experts or doctors in name only, I suppose. But we are trying to grasp and see certainty in a realm of uncertainty. That's our job as, market analysts and, just trying to see where things are going. So, it's it's good to be informed on things. I think
it's nice to have an opinion on stuff, but if you're going to put your opinion up to bat against what the market's opinion is, you're going to lose every time.
Mm-hmm. Yep.
So that's why we care about what the market thinks about things, because the market will never lie to you. It's never going to tell you what you think you want to hear.
Yeah. 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 So, yeah, we're trying to we're not making silly predictions here. We're trying to make fact based evidence, empirical decisions on what we have in this day and age. So, to that end, I'll do a little bit of fundamental analysis and tell you guys kind of what I'm seeing from what's going on in the markets, and
Do it, Mav.
I'll do this nice and quick. And this is I fired PowerPoint guys. I'm done with them. They're enough crashes, enough of that stuff. This is we're
Do
going back
tell.
to
What have you gone to?
back to Google Sheets or slides or whatever it is.
Oh, Google Slides.
Yeah, yeah, it's a workhorse. Anyways, so what's going on in the markets? I think Doc did a good summation. Holy volatility, Batman. We these last 2 weeks have been, especially the last week, has been just historic in a lot of ways. Historically, the most that the Dow has ever lost in a day. Historically, one of the worst weeks in the history of the markets. Just up and down all over the place. It feels like a roller coaster ride. And certainly we can tie this to some of the factors going on right now, but it's just this compounding fear cycle that the markets seem to be trapped in. And then you add in, sprinkle in some elements of, the presidential election and the Fed. And so we'll cover a little bit of that right now. But yeah, it can be kind of a lot to digest. So we'll work on that right now. I think the first thing is, as Doc was just kind of teeing off there. Yeah, I think today is, in summation, what's affected the equity markets, at least in the U.S., is that investors are reacting positively to the Super Tuesday performance by former President Joe Biden, Vice President, sorry. Uh, this comes from, I would say, three main perspectives. First, that it was kind of unexpected, at least from a week ago. This is Joe is I suppose a little bit more moderate, and so a little bit more palatable by the markets and corporations and
A
things of
little
that
bit
sort.
more gaff prone, maybe.
Yeah, potentially. But yeah, they see him as the simpler, easier choice. At least for contention, just because Bernie is a radical in a lot of ways, and you were gonna have, it still can go in Bernie's favor, but a lot of things have to go right for that to happen. It's as Doc was saying, it's a pretty. What's Bernie setting at on that FTX chart? What percentage chance has he got?
Oh, let's see. Bernie is showing right now. Man, he's plummeted the last 2 days. Right now, he's sitting at 5.5%.
Yeah, yeah. I think the last time I looked at 538, he was about 8% or so. So it's not looking too good. And that's I get the I guess apathy or the disappointment with some people, but yeah, we were potentially staring down the barrel of two populists, Bernie and Trump facing off in November, and I think that scared a lot of people. And I think Bernie's radical opinions on policy and economics also scared a lot of people. Good or bad. We're not here to make judgment calls on that, but that's kind of the reality of what was going on. So yeah, I think just over the last week, is there's been a lot of uncertainty with things like COVID-19 in the market. I think there was a little bit of a reaction to that, and people wanted some certainty. And people know Joe as former vice president. So, anyways, now I think the most prescient question we have to ask, at least regarding this year's presidential election, is really where the market's going to be in November of 2020. I think that dictates just about more than anything else who will ultimately clinch the presidency. If we're in a down market, I would say that better supports Joe's position. But again, as a moderate, I think he's going to have less staying power than if the market had been down for Bernie. I think Bernie would have had a better chance in that scenario. Now, if the
They
market,
don't care. They don't care about Joe.
yeah,
It's just if Trump is going to own this market on the way up, which
right.
he has claimed, he is definitely going to own it on the way down. And if things are well below where they are today, then that significantly increases Joe's chances because people will go for change every time. We saw the same thing happen in '08.
Yeah, that's exactly right. And yeah, I guess the contrapositive to that is if the market is slightly sideways or up come November, then I think it's Trump's presidency for the next 4 years. So yeah, I think that's a very clear narrative for people to get behind. And There's a lot less uncertainty with that. So that's sort of what we're looking at right now. There's obviously a lot more externalities that go into something as complex as the presidential election, but at least from the market side of things, that's how we're reading this right now. So yeah, that's a good place to start. But I would say today's market rally is just a little bit reactionary, a little bit short term, if you will. And I think what we really need to talk about. Uh, this is a little bit of a joke, just to breathe some levity in here. But yeah, as we saw yesterday, or well today, the market cheered as the Federal Reserve cured coronavirus with some cheap money. With just a click of a button, the Federal Reserve did the impossible and found the cure for the coronavirus. Who knew that the cure for the coronavirus was cheap money?
There you go.
I've instantly felt better after shooting up some cheap capital in my veins, a social media influencer said. Uh, no, but in all seriousness, we do need to kind of talk about like what the last week of trading has, what's really transpired. And we were here a week ago with doom and gloom and the end of the world, and now it seems to be a little bit more palatable. And so what's going on? So first off, I would easily say that the cut by the Fed was an overreaction. I think very strongly that they should have waited a little bit longer to see if it was really necessary, if there were really necessary economic effects. And they certainly should not be reacting to stock market tantrums. As a body of, just a central bank in general, it seems very knee jerk for them to be reacting so strongly as they did in terms of their cuts. So I think what we're going to see here is that just around the world, this has become the new normal, right? All these nations are getting used to cheap credit and massive government spending. And honestly, they're in a world for hurt if rates ever do need to rise in response to economic downturn. We're really running out of options and tools to combat runaway, the same sort of environment we saw back in 2008, where things were getting really bad really quickly. And that was the big fear over the last week, is that really the coronavirus just was sort of the catalyst, right? It's as we talked about, it really has a low fatality rate, has a high viral rate, yes, but at the end of the day, it only can do so much damage. But where it's really causing hurt is in this almost economic virus that is spreading around the world. And once one country has a supply shock issue and their economy starts to go under, you start to see a domino effect of all these other countries starting to get even worse. So it's something that I think people are starting to wake up to that possibility. So the thing is, if they wanted to raise rates, we're quickly getting to the place where they really can't. The last time that the Fed tried to was at the end of 2018, and that's 9 years into a raging bull market, and it failed spectacularly. And so if we can't raise rates at all-time highs at the end of or after 10 years of essentially a bull market, then the only answer is that there's only ever going to be more cuts into the future, or starting to consider more and more, as Doc was kind of talking about, the potential of negative interest rates and where that goes. So yeah, lots to unpack there. Oh, this is a repeated slide, aka optical illusion. But I guess this is stressing the point. So two thoughts here. All right, so the Fed has been dropping by 25 basis points as they wanted to, and they've been kind of feeling out the reaction up until now. But now for them to just suddenly drop by 50 basis points and between meetings, they really must think this is very bad. They really reacted very strongly to this, and I think that's why we saw a lot of the sell off yesterday. Is that
Do you know the last time that this happened?
what was that?
It was in the fall of 2007,
Wow, yeah,
which is right before the market started its tumble to the downside.
wow, yeah, yeah. So it that I think also definitely contributed to what we saw yesterday, and what we'll probably continue to see going forward. Like I said, today's market rally might be just a short term brief pause before we get back to the meat grinder of the market volatility. But yeah, I think there's very good reasons to believe that given the expedited nature of this cut, given the severity of it, we were predicting back on Monday just that, okay, yeah, it's pretty well established. We're pretty much expecting that the Fed will cut by, 25. We gave it about 100% chance of happening. That was to be expected. But the 50, we gave that about a 50% chance. And so for them to just straight away go to that, yeah, the market interpreted like we kind of expected it to. So the other point or thought here is that dropping rates is not going to fix people not being able to go into the office or being afraid to participate in the economy, get on planes, etc. So this really has to be more of an on the ground response. This cannot be solved by fiscal policy or monetary overreach. And so, yeah, we definitely need to address this. Economic slowdown connected with the spread of the coronavirus is a supply side phenomenon. And monetary policy can only do very little to offset a supply side contraction. So this is a major point to take away because unfortunately, no matter what these central banks of the world do, if there is a slowdown, this sort of coronavirus, economic virus, as we talked about, it can't just be solved by monetary policy alone. It has to be more of an application thing. It has to be more of a, you know, getting people to get off, get out of their houses, get participating in the economy again, and it's hard to do that just through rate cuts alone. So um, this all sums up, why do we care? Why do we, as sort of contrarian investors, market analysts, why do we care about this? What does this mean? Especially as we consider the possibility that we're going right back into more quantitative easing, potentially approaching negative interest rates. Even considering something as crazy as helicopter money, where we're literally doing kind of what Andrew Yang promoted, which is like just giving stimulus directly to consumers and saying, "Here, go spend," just to drive economic growth. All of that, is some of the radical, unfortunate tools that the central banks have to turn to now that they are kind of backs up against the wall. And where does that leave us? Well, as central bank policy continues to promote, this sort of sense of unlimited, cheap capital, it continues to promote crypto, even if it really doesn't mean to. And so, what we can read into that is, if debt is the new money, risk on becomes the new normal, and we're definitely seeing that today in India as their Supreme Court ruled the, whatever policy that pretty much prevented banks in their country from I guess processing or being the on ramp to crypto exchanges. Now that that's out of the way, they're kind of open, available to the world market. As we can see, here's WazirX, which is an Indian exchange, just absolutely going ballistic right now. So India is officially on board with crypto, and that's really cool to see. And I think we're going to see more and more of this, either from a policy side or just from a consumer side, as people become more and more, risk on assets, risk on investment becomes more and more palatable as it becomes the new normal. This is because if risk on is the new normal, risk on assets will thrive. People have to be putting more and more of their investment portfolio towards more and more risk. So even though, as Doc was talking about earlier, we don't see Bitcoin as this safe haven asset or this, magic bullet that's going to protect your assets at all times. Certainly, even gold doesn't do that. But what it does do is help you play an alternative route, an alternative asset class that is by design very risky, yes, but also has potential in a market that thrives on risk. So hopefully that sort of makes sense. Is that as the markets, as the global economy trends towards negative interest rates, as it trends towards more and more of this cheap capital, people are going to need more and more yield. They're going to need more and more of alpha to justify their investments. And that's an environment where deflationary assets that have, yes, risk, but also sort of this permanence become very attractive. And so, yeah, it's sort of the new paradigm. And don't want to get too deep into all of this, but hopefully that sort of makes sense as we're reading it from today. So lots of these sort of macro forces, macro trends playing out, even on the daily scale at this point. It's kind of, I mean, we talked about this, guys. 2020 is just absolutely it's already been uh quite a year.
The
This
party is just getting started.
absolutely. So
This is
it's
just the first move.
right, exactly. So we're within 10,000 blocks of Bitcoin's halving. Ethereum is still figuring out their prog pow issue, but still looking at July for their 2.0. Stuff is still happening in crypto, but as we make the point over and over and over again, where we see crypto starting to really thrive is as the larger markets start to break down and look for alternative means and places to park capital, other markets to thrive in. So we've got a lot of room to grow. We've got a high ceiling to hit. So yes, does that translate to the $135,000 number for Bitcoin? Comes from Willy Woo, and he looks at it more from a supply side or stock to flow ratio kind of perspective. Truly, no one knows, and yeah, some people are calling out the silly predictions. I will be the first to get on board with that. There's no knowing where things go because it's very unknowable at this point. What we do know is that this market, this asset class, is in a very good position to be, I guess, partly contrarian, but also partly reactionary to some of the forces going on right now. So I don't want to get too long-winded here because I always get called out for it, but hopefully you guys find that a little bit interesting and effective. One thing I want to do before I turn it over to your guys' questions is we want to highlight Doc's new book, which he just put out. Probably the worst time he could ever do it, but it's out there now. So if you guys would like to pick up his new book, which is almost 300 pages long, it's really awesome. I'm starting to read through it. It's over at readysetcrypto.com/book. You can get it on Amazon. You can get it in print, which Doc recommends, or you can get it on Kindle. Also cool. But yeah, Doc, if you want to talk briefly about it and what's going on with fractal energy trading, go right ahead.
Well, this goes right along with the course that I did like a year and a half ago. The point is that I've been watching markets every single day for the last 15 years that I've been independent. And after a while, you tend to see some things, right? You tend to see the same patterns repeat. You start to see the same things happen. And what I found was it really boiled down to four simple rules. And that's why the title of the book is Fractal Energy Trading: Four Simple Rules to Profit at Any Market and Any Time Frame. And these four simple rules also tied in with things that I see in the natural world, like things that we have learned from nature in terms of just like how a family operates when they travel, things like that, which is just like how markets split into different time frames. And so I think it's really liberating to be able to look at a market, a financial market, and not really care what it is. It could be any financial market. If I can split it into different time frames, I can understand how it's going to move with these four simple rules, such as rule number one is that larger time frames dominate the trend. Like if you're taking your dog for a walk, you basically, let's just assume that you're 10 times the mass of the dog. If you've got it on a leash, it's going to go in the same direction that you are eventually, even though it's going to trace out a lot of different steps. It's probably going to go 10 times further than you are in terms of the number of steps, but you'll both arrive at the same place. And the reason why that's important is because smaller time frame moves tend to revert back to the mean, and you being the mean, right? So this is what I see all the time, is that markets will pull back, but they'll always revert back to a larger time frame trend. That's just one of the examples that we have with this. And I think the way that I explain it allows people to really understand what's happening, so you can look at a market and not feel like you don't know what's going on, or it's not just a random collection of candlesticks that are out there. And what people usually do to get past this point is they start throwing on all these different indicators on there. Well, let's throw on the parabolic SAR. Let's throw on the Keltner channels. Let's throw on the Bollinger Bands. Let's put some moving averages on here. Ooh, exponential moving averages. And
let's
next thing you know, you've got a pile of spaghetti on your chart. You don't know what's going on.
let,
So
let's put
being
on the
able to
weather bug one.
simplify, I think is a key. And there's no professional trader I've ever met has got a pile of spaghetti on their charts. They're always very simple, crude systems because they understand how markets move. That's what I want to help you guys do.
Also saves you money because TradingView only allows you to have 3 indicators, so you guys can.
That's a good point.
So yeah, 2 other points before we jump into questions here. Whatever questions you guys got. We are starting the coaching sessions tonight for our Elliott Wave course participants. So if you guys are a participant of that course or would like to join, it's over at readysetcrypto.com/wave. We'll be sending out a little invite for all the course members right before we go live. I think that's starting 7 p.m. Eastern time. Is that right?
Yeah, it's about 2 hours and 20 minutes from now.
Cool. Yeah. And so that'll be just a private session. Shadow sitting down teaching Elliott Wave trading. Taking questions live. It should be a good time. So yeah, looking forward to that. And yeah, what else we got? I'll forget the other thing, or remember it here in a sec. But uh, wow, lots of questions about mining. Yeah, it's a supply and demand thing. I think there's always going to be difficulty adjustments based on who finds what a profitable time to mine or not. So yeah, I think there's definitely some pressure from that side of the market, but whoever gets off the market, whoever stops mining, they're just going to be replaced by someone else who sees that as an opportunity. Yeah, it's we've definitely seen robustness in terms of the markets through that.
Just really quick here, guys, what I always want to impress upon you is don't be caught off guard by any moves that you see in the near future.
Yeah.
So it is your job as a risk manager, as an asset portfolio manager, to understand down to the penny or whatever notion of currency that you use, down to the Satoshi, what your risk is. And so what I'm always impressing upon people is don't enter a position unless you know where your exit is. And so if you're already in a position, if you don't know where your exit is, take the time right now before things truly get spectacular and understand where your exits could be, should be, and don't put them through your bias. Don't just look at them from one point of view. Look at them from an upside and a downside point of view. Understand where your exits are with every asset that you have.
Yeah. So thoughts on the coronavirus and the effects on the economy? I mean, hot take is that yes, there's going to be some, and yes, it's going to be. I think we're still discovering the widespread reach of this thing. Now, has there been an adequate response? Yes and no. But yeah, it's certainly not done yet, and I think there will still be these sort of cyclical patterns of fear, and then trending towards irrelevance. But yeah, based on the characteristics of the virus, based on there's a really good whatever. There's a good map that kind of charts all the different places that coronavirus has popped up, and just since last week, we've seen the cases in the U.S. like triple, and there's still been kind of a slow response to get on top of that. So yeah, it's I think the worst might be behind us, but it also might be yet to come. And as it translates to the economy, remember that the market and the economy are very different things. But yes, there will be, I think, some short-term disruption. Like Goldman Sachs looked at, their projections for 2020 for U.S. businesses is that they're going to be neutral, if not negative, in terms of earnings, which is not cool to see. But yeah, there's some reality staring the market in the face right now. So, yep.
Sales of Purell are going through the roof.
Yeah, yeah.
Okay. Any
Yeah.
other questions, guys?
Yeah.
Let us know if there's any other questions.
Has been yeah. It's already been kind of a fun week, just all over the place. Yeah.
Oh, like, yeah, you guys, I mean, everybody thinks this is the worst we've ever seen. The financial crisis was just
Right.
awful because it was exacerbated by policy mistakes by officials. Because they're like, one of the actions that they took was they said, okay, thou shalt not short financial stocks starting right now. And it was that edict was issued at night. And so by the next morning, you could not be in a naked short position in financial stocks. And it completely blew up the market. And then also what you had was you had the Fed chair coming out and giving Friday morning um, basically updates or rate cuts and stuff like that, which completely blew out anybody with an option position that was settling that morning. And these guys all knew what they were doing. And it just created this extreme mistrust of the financial system. One of the reasons why we're all here today.
Yeah, funny.
Okay,
Yeah.
all right, all right. Youngster B wants to look at the charts. I was going to save
All right.
you the
Oh
I was
man.
going to save you the embarrassment of looking at this, but here's your Doge. Here you go. Let's bring it up in full screen and full glory here. Here's the weekly chart on Doge. And if you were to put a marble up here, which way would it roll? I would say it would roll to the downside. It would go this way, right? So we're in an extreme downtrend on Dogecoin versus BTC. As a rule, I'm not looking at anything unless it's in a weekly uptrend. So what I want to see from Doge or any other asset, any other, shitcoin that's out there is I want to see some type of series of higher highs and higher lows. So rule number one of the book is larger time frames dominate the trend. And right now we have a larger time frame dominating the trend to the downside, which is Dogecoin. That is not my opinion on it. That is merely fact of what's going on. Again, this is what you do to separate fact from opinion is you look at a chart and you say, what's the trend in this? And you can't fudge it. You can't fake it. You can't hide behind your tribalism on something like this. It's either trending up or it's trending down. So it's your choice as to which asset you're going to invest in. Choose wisely.
Yeah. Yeah. And for those who don't know, it's currently pumping, or it did pump, just based on Elon Musk talking about it on Twitter, saying it was his favorite or the best one or whatever. So that still hasn't. We still have not gotten away from the Twitter shilling pumps in this space, which I guess is good and bad to see. But yeah, I'll just do rapid fire here. Thoughts on Link? People also brought up Tezos and Kyber. Those are all really good right now, because they're interacting well with the DeFi space, security tokens. Tezos is in a really good place versus Ethereum, simply because Ethereum, is kind of doing what Bitcoin did in 2017. It's got two very divisive camps that can't really agree on the Prog Pow issue. So it's a matter of governance. I would also look at Decred to also potentially benefit from that. Link, still needs to do more to kind of get integrated with DeFi and all that sort of stuff. But it's doing a good job, raising capital and getting partnerships. So that's all cool. Let's see what else we got. Yeah, that's. mm, Oh, one other thing. The thing I forgot is I'm going to be at the Bitcoin 2020 conference in March, or well, yeah, it is March. So there's going to be a lot of Bitcoin OGs there. Should be kind of fun. Should be not chilling the conference or anything like that. In fact, you can get a free pass for it if you have an eToro account. I just saw that, so yeah, it should be fun. Tony Hawk's going to be there. The Winklevi are going to be there, so should be a little bit of a party. Uh, but yeah,
I'm gonna do a quick share here, Mav.
yeah,
Algo ran, so people are talking about Algo. This is Rule number 2 that I talk about is reversals begin from the inside out. So on the daily chart, we're starting to get a reversal to an uptrend on Algorand or Algo. And you can see that this is it's just barely starting to work itself into a weekly uptrend. So this is the very first swing off the bottom. So you're still really, 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 can I highlight that, really early into this one. And, like this to me is not, so many people get so like hung up on, they see a move like this and they go like, oh my God, I'm missing out on it. And you have to put it in perspective in terms of the larger context of the chart, because the larger context of the chart is this thing is just creeping up off the bottom. Again, nobody gets a medal for getting the bottom tick of a chart. What you're trying to do, what you should be trying to do is as an asset manager, as a trader, you should be looking to get into a swing with a high probability and just get the meat of that move. If you get the meat of that move with a high probability entry, you're good, right? So getting the very bottom tick of this doesn't interest me. I want to wait until this thing clearly has an established uptrend before I'm going to use my capital on something like this.
Cool. All right, I'm going to take three more here. So Zach asked a really good question about sort of the thoughts, or can we share anything regarding the future of Ready Set Crypto? And to Zach, thank you for asking that question. We're gonna have something really exciting in the next couple of weeks here, so stay tuned. But yeah, we've been working on it for a while, and we're really excited to share it with you. So lips sealed until then, but yeah, look forward to that. There was also a question about do we still have the Omnia deal? Yes, if you go to readysetcrypto.com/wave, you can get the 3-month rate, which will be sort of discounted versus doing the monthly. So highly recommend that. And, there was also a question about if crisis strikes and everything crashes, including Bitcoin, would Bitcoin recover sooner than the other assets? That's a great question. We don't know, because we don't know what Bitcoin does in a recession. However, I think we can look at, and I talked about this in my newsletter, I think on Monday for our Omnia people, how I'm sort of looking at playing this from the stock market equity side. What I'm investing in in an uncertain market that is trading all over the place. And essentially, the short answer is that like tech is doing among the S&P 500 right now is doing pretty well at riding through this storm. It goes up and down just with everything else, but I think it's positioned to do well coming into this, coming out of it. And to that same point, I think Bitcoin as a technology digital asset is fantastically positioned to weather the storm long term. Certainly it's going to be sold off in the short term as people panic and fear sell and all that sort of stuff. It's not the crisis hedge that sometimes it gets painted as. But at the same time, I think what inherits this economy going forward is around service-based economy, is around tech-based economy, and is really just about building the next economy, be that an artificial intelligence economy, being that some sort of digital economy, what have you. But I think tech is well positioned to come out of this thing, wherever fiscal policy, wherever the virus takes us, wherever the presidential election takes us. Technology is well positioned for this decade. So that's my position on it. I'm going to write a whole book about it someday. But
A book? Did you say a book? A book? There you
yeah,
go.
yeah. All right, cool.
Get to it, man.
Alrighty. Let's close this one out. But yeah, guys, thank you so much for sticking around. Hope this was a little bit beneficial, a little bit fun. As always, we do this every Wednesday at 4 p.m. Bitcoin is not a scam. Come on. It's getting spicy in the comments, so it's time to wrap it up. But
yeah, the salt factor is definitely up there now.
Turned up to 11. But yeah, guys, we appreciate you so much being supporters of this channel and riding through this storm with us. We're not going anywhere. We're more than happy to be your shining light in the darkness. I don't know. All right, I'm getting too much here. But as always, guys, appreciate your time, appreciate your patronage, and we'll see you next week. Cheers, guys.
See you guys.